This conference will now be recorded.
Good morning, gentlemen. This is Clueless Day Trading Frank. It's 9:06 a.m. on February 29th, 2020. This is a ACS, what we call advanced coaching sessions for enrolled students. And today we have Aldi, Ray, and a few other people who are going to be streaming in. Full disclosure, this is purely for financial education, not for any solicitation or advice. More importantly, these sessions are recorded and uploaded to the YouTube channel for you guys to review at a later time. The sessions are kept private because you guys are paid students of these training sessions, and if we do make it public, we'll certainly ask your permission for that. On that note, let's begin. So a couple of quick, this being the first ACS session, let me explain a couple of things. So what we try to do on these, and we try to keep it in a more open format, is we try to cover the basics and we move ahead towards the more advanced stuff on the technical side, on the trading side as we move along. So let me get, so the format, it depends on the level that somebody's coming in. So it is not just a standard format of just using the same stuff over and over again. So one of the things that I like to do, which has worked for a lot of people, we try to customize a little bit for you guys. You with me so far?
Yes.
Okay, very good. So you can see the writing board, and I'm going to give you, and being, like I said, it's more of a customized thing. So depending on the level that you guys are coming from, I'm going to ask you a couple of questions, which I know I've spoken to you guys before, but then we're going to move forward. So first question that I'm going to ask you is, you both are reasonably new when it comes to, and one person at a time, obviously, Aldi, for example. Aldi, from a trading perspective, and especially options trading, what's your experience, or how long have you been doing it or trying to do it?
Since a week and a half since I joined.
Okay, I remember that very well. So, brand new, so that's perfect. And the same question applies to Ray.
Same time period.
Perfect. So we can start off from, like I said, scratch. So that's perfect. So I'm just going to put absolute beginner. Okay. When it comes to stock markets, and I know I've asked you guys this before, but it's important to reiterate that when it comes to stock markets, as in buying some stock, selling some stock, or looking at the stock markets, how long would you say, you've done that?
A week and a half to
So you
yeah,
never
week and a half.
So you never followed the stock markets or anything till now?
Well, I did a little bit, with my 401k and stuff like that, but that's about it.
Okay, that's about it. Okay, so not from the trading side. And Ray?
No.
Okay, so again, we're looking at total beginners when it comes to the stock markets. Great. When it comes to, and I think I know the answer, when it comes to what we do here, and we try to do it to the best of our abilities, which is technical charting and stuff like that, I would assume that that's also something brand new, right?
Correct.
Okay.
Yeah. Yes.
Okay, that sounds good. What is, when it comes to understanding options and how they work, why they do what they do, options trading, I am assuming that it also falls in the brand new category, right?
Yes.
Okay, good. So now we know where to start. So one of the things that, so in that case, what we're going to start off today is we're going to open up the first session with looking to see how options work, and I'm going to keep it very simple. I know I have videos of that, which is very, very important. So this is going to be We're going to talk about the option basics, and I'd like to remind you guys that there are fantastic videos on YouTube on how options work, what call option is, what a put option is. I know you guys know that because you've been trading a bit now for here. But more importantly, there are fantastic tutorial videos on that. Also on my Google site, which I'm sure you guys have. So here's an important question: have you guys visited the? Hold on one second. I'm going to turn the volume down on this. Okay. Have you guys spent any time on the YouTube channel where under the playlist that I keep on talking about, the new member introductory videos?
Yes, I've watched a few.
You watched a few. Okay, good. So
Me too.
yeah. Okay, good. That gives you a basic idea. And remember, when you listen to these videos and stuff, as you're picking up some of the things, you don't have to listen to the whole thing. Just fast forward it. You know what I'm saying? But pick the ones which talk about options. Pick the ones which talk about. There is one very important one which I did a long time ago, which is very helpful, which is understanding the basics of chart patterns. And I'm sure both of you have had a chance to look at that. That's the first one you should look at, because that one I explain in very simple terms all these technical patterns on charts. Did you guys come across that?
I missed that one. I haven't seen that one.
Okay, that's a very important one. Find that under the playlist, new member introductory videos. It says chart pattern analysis, and I explain, and we can do that on these coaching sessions too. But I explain the dynamics behind each of these patterns, which might seem completely like weird stuff, but they work. As you can see, they work. Even in these crazy week that we went through, which is monumental, but it's still, we managed to get an idea on the technical side, and the market actually did bounce from exact technical level that I showed, and I know both of you saw that. So options basics talks about like how basic options work. We're going to look at a bunch of charts because that's what you guys look at when I put it out there, and then we are going to talk, and we're not going to get too detailed. But today we're going to cover a bunch of broad topics. Then we're going to get really detailed on the next session. We're going to talk about. We're going to look at what was I thinking of here? So options basics, the charts. That'll cover, and then we'll add on whatever that we need to add on. Fair enough?
Yes.
Okay, good. Very good. Let me just see here. So let's talk about, and this stuff you already know, but it's good to talk about it. Let's talk about the options basics part. So basically, we are betting on the market. Real simple. Okay, we are betting on the market, and I'm sure you guys have bet on things on whether it's a casino or betting on horses or whatever the case may be. So we are betting whether or not. Let me clear this out. We're betting whether something's going to go up or something's going to go down. Now, the advantages of options, which I consider to be very advantageous, and not just me, is you don't have to put a lot of money down in order to control the shares. So let's say, for example, we have a $20 share of XYZ, $20 a share. If you needed to, and you think the stock's going to go up to 30. So if you had to buy stock, and let's say you bought 100 shares, you have to put down $2,000. You guys with me so far, right?
Yes.
Yeah.
Yes.
This is the basic. So I'm going to go quickly. So or if you want to buy 1,000 shares, you got to put $20,000. So that's a bunch of money. And you want to buy different things, so you want $20,000 just on one thing. You got to have a pretty large portfolio to do that. And if the stock goes up to 30, you make a lot of money. You make $10,000. $10 profit. You're at 30,000. So you're happy. With the case in options, one contract. In this case, we are betting the stock's going to go higher, so we call that that's called a call option. So one contract. I'm going to put 1C. One contract controls how many shares?
100.
100.
There you go. So one contract, 100 shares, 1,000 shares. you want to have 10 contracts, right? So you need 10 contracts to control 1,000 shares. Here you had to pay $20 for it. Here I'm just making it simple, you'll probably have to pay $2 per call. So for $2 per call, we have to put down, for 10 contracts, we have to only put down $2,000 instead of $20,000. If the stock does what it's supposed to do, or we're betting it's going to do, it goes to $30, then you will make, if it goes to $30, this thing will most probably be 4 times more, depending on what strike and this and that, which we're going to talk about in a second. So you will make, so let's say if the stock does go to 30, then you'll make $8,000, and just for a $2,000 investment. If things go wrong, which it does in the market time to time, and it just doesn't come up, and the stock just explodes lower, your maximum loss is capped at $2,000. So the point is, you can go below $2,000. But if the stock goes, which we saw a bunch of stocks we did this week, which went ballistic, 100%, 200%, 300%, then your upside, and this is the most important thing about options, your upside is unlimited. And your downside, you know what your risk is. Your downside is just what you put in. Worst case scenario, that 2,000 is your downside, which will go to 0. So that's a huge advantage. Lesser money, bigger profits. Let's move on. Now, the other thing with options is, depending on the type of options, I'm just keeping this, let's make this bigger. I'm showing you the advantages, and I'm going to talk about the risks, which we already know. So the other thing with options is that they tend to move fast, both up and down. So if you're in the right direction, your profits are almost immediate. You guys are with me so far? So the profits are almost immediate, whether it be a couple of hours, as we clearly see almost every day, or if it's it can be hours, days, and the longer term options that many times we sit on can be weeks. So that's fantastic. Now, let's talk about the actual option structure, which I explained one day, but you guys already know that. What are the two parts of an option contract? What are the two variables?
Calls, time and
Yeah. So
time is one.
So yeah, the time value, we call it time value. Okay, how long you have to hold the options, number one. And the second part is called intrinsic value. That is, what is the actual value? Intrinsic, which means internal value. What's your net asset value? You guys understand that, So what is the net asset value or intrinsic value of that option? So let's call it NAV, the net asset value. So these two things are the ones which determine whether or not you're going to make money or you're not going to make money. Now, one of the things that a lot of new traders do is, let's say a stock is trading at 20. We're going to stick to the $20 thing, and we think it's going to go higher. And we think it's going to go to 30. So what they do, in some cases, they want to buy the cheapest option. Okay. Please, can you just mute your microphone a little bit? Okay. So here's where the difficulty, not difficulty, where the one of the mistakes that a lot of new traders do. So if you buy in the money, you can buy in the money. We call it ITM. That means you are buying a call with a strike price, which is $20 or less. So you would be buying in the money, would be buying a March, let's say March 20 call, strike price either 20 or even 18. When you go in the money is 20. And there's a term called deep in the money. Okay, that means you're buying more protection and you are paying more for it. So if you buy a strike price 18, let's say you buy the one at 20, it will cost you, let's say $2, like we did in the past example. If you buy a strike price 18, which is below where the stock is trading at, this is the stock XYZ, then you will most probably have to pay $3. And I'll explain to you there are benefits to it. And there is no risk to it, but there is benefit to it. But it will cost you more. But what a lot of new traders do is, because of the constraint and their capital, they don't have that much capital, whatever, or they just don't want to spend that much, they will buy the strike price, what we call out of the money, OTM, way out of the money, and buy a strike price of 30, which will obviously cost a lot less. And let's say that costs $1 or less. Well, let's call it $1. Are you guys with me so far?
Yes.
Okay, good. And stop me with any questions, because this is for your benefit. So what happens is, and these are March 20th, so we got 20 more days. You got three trading weeks left for these calls to work out, and hopefully they work out much sooner than that. So the problem is that if the stock is not moving in this direction at a, generally doesn't have to move every day, but generally if it's not moving up in this direction, then the time value, the number of days you have, starts to, we're going to call it time value. This starts to decrease, time value. And if the stock is kind of stuck, let's say at 22, 23, you're up a little bit. But if it stays around there, as we're approaching the expiration date, which is March 20, that's the day the options expire, then your intrinsic value, or the underlying value of the options, we're going to call it IV, is also going down. So you land up basically losing money. Now, if you buy it all the way at 30, this $1 call most probably will be down to 20 cents if nothing happens. Or let's call it 40 cents. The one which is which you paid more for, the one which is deep in the money, below the strike price, this one will hold its value, and you'll probably be up to, if the stock goes to 23 whatever, you'll probably be up to $4 or more. Let's call it, and this one, which you bought in the money because the stock is trading at $20, this most probably will be maybe $3. And this will be more than 4 because you paid more for it. But this one, because it's not moving in that direction fast enough, and the number of days that you have for the options is starting to come down, you'll keep on losing money. So you hear a lot of the times people say, man, the stock went up, but my options went down. That's because you bought it cheap, way out of the money. This is a very important concept that all of you have to understand. Now, some stocks we bet on, and I buy out of the money because either they're too cheap, they fell too hard, and my charts are telling something, blah, blah, blah. So that's a different story. Or if they're lottos and we're betting that it's going to get there at some point, that's a different story. But in general options trading, this is the thing we have to all understand. Okay, so are we clear on this, guys?
Yes. Yes.
It's a very, very important concept. Options.
Hey, Frank.
Yes, go ahead.
Sorry, Frank. This is Al.
Yeah.
Hey, just a quick question. So most of our options that we're buying, would you consider to be in the money, or?
No. Most of the a lot of the options that we buy, because when you buy, let's say, Netflix, or things which work out for us, fast trades. If you buy in the money, you're going to pay a lot. So, but because they're fast-moving stocks and the markets are volatile, and my charts are showing that they could bounce $4, $5, $6, $7 within minutes, sometime, as you know, that we are always buying out of the money, but not crazy out of the money, just a little bit out of the money.
Okay.
Now, the ones which are like and I'll talk about that in a second. Depending on the price of the option, how I use my method in buying the calls. So we'll talk about that in a few minutes. So now the thing to keep in mind is that options is a very wide field. Okay, it's actually the guys who are the real options derivatives players. They construct all these different strategies, and what we do is we buy binary options, whether it's going up or whether it's going down. But it is a very wide field. That's why I suggest at your own time, pull up a couple of Google, YouTube videos, just type it in. And there are, like I said, there are options tutorial stuff with like 2 million views, because those guys, somebody put up explained it, like in very, very detail. I highly suggest that you do that. Time to time, I used to go and listen to something. You always pick up something. Now, the thing, what was my next thing that I wanted to cover? When it comes to, this is the next topic number 2. So one of the things that a lot of new traders get confused on is is why aren't some of these options, why don't all options move the same way? Why does an option on Apple, for example, move as this, it's got a high correlation. In other words, it moves very nicely with the stock. And why does a biotech stock, let's say, let me pick one, like let's talk about the Regeneron, which is a major biotech stock we made some money on this week, as you know, good money. Regeneron, why do the options move slower? And why are these moving faster? There are different characteristics to an option, okay? And let me try to get a image of that. And they are known as Greeks. These are the options deltas. Now, I don't want to get into it too much because my business, I like to keep things simple, but it's good to know that. And I'm going to show you, pulling it up from my other screens.
Hey, Frank, this is Audi. I wanted to ask you a question.
Of course. Go ahead while I'm looking it up on the other side. Yeah.
Can a call lose its value before the expire of the date?
Of course. If like I explained, if the stock is not moving in that direction, and you don't have and the stock is going, we're going to talk about options risk in a second, and the stock falls, certainly it can lose value, and we see that every day. So yeah, it can.
But before the expiration date?
Of course.
Like, for example, okay.
No, go ahead. Your question is a good question, so go ahead.
Yeah, for example, I bought let's say Doku, March 20, $95 call. Can that lose all its value before March 20? Like,
okay, so let's say I don't remember because DocuSign is holding its thing. What's the stock price on DocuSign? Let me look it up. I forgot. Okay, stock price on DocuSign was it closed at $86. It actually had a very sharp move. It went from 77 to 86. This chart is fantastic. Okay, so let's talk about DocuSign. And March 2090 calls, right? The strike price is 90 because that's where it gravitates to. It went above 90 at one point. So the way that this will lose I don't have the exact, let me just look it up. Let's look at the actual price. Okay, the March 90s are trading at $5 right now. Okay, so this is the actual price. I looked it up from my other screen. So $5. So your question is, can it lose value? If the stock is and there's no like exact 1 + 1 = 2. Options have a lot of different variables. Like I said, it's called the implied volatility, delta, theta, and gamma. Theta is options decay. That means the options loses value a little bit if the stock is not moving. So if by March 20th, but forget March 20th, let's look at the week before. By March 13th, DocuSign is still stuck between 90 and 91, for example. We have lost 7 days. There's 7 days less, right? Because we are getting close to the options expiration, and this can this I would say will lose about 20%. Will be down to $4. However, if DocuSign bounces towards 92, I'm sorry, DocuSign is right now at 86. So let's keep that in mind. So if it goes to if it basically is moving towards $90, then this will be and DocuSign is a terrific option. It's not like as fast and crazy as the Teslas or the Apples and things like that. So this one will most probably be around $8 if it reaches. If the stock goes up $4, this one most probably will be around $8. However, if it's stuck around 86, 87, 88, and we only have a few days left, there is a possibility that the option will be down 25%, down towards $4. Can it lose complete value if the stock is, and you bought it when it's at 86, and the stock is stuck around this 86, 87, 88 level? No, it can't lose its complete value. You will still have the chunk of your move in there, but depending on the market, depending on the charts, if you hold it all the way through expiration, the chances are at that point there is no time value. Let's say the day before you only have 1 day left, so literally there's no time value left. Then those options will move down probably towards $2 if the stock is stuck at the strike at the level that you bought it at. Did you understand? I mean, I'd be happy to explain this again.
No, yes, I did. Thank you.
I think the simplest way of looking at it is basically is basically that you need to move towards the strike price as quickly as possible, and that the number of here is the one that I want to and that you have a bunch of days left. Now, there's a lot of complexity in the market. Many times, and I've shown this, and there's no way to measure it because of the extreme volatility in the market. An option can lose value, and then and almost on the day it's expiring, and you think you lost it all. Let's say you put it in the option strike price was $2. We're always looking at 2 right now, and it's down to 50 cents or 40 cents, and it's happened to me a lot of the times. And depending on the market, right on the Thursday or the Friday that the options expiration, they'd run the market like crazy. And these are things that are out of our control. These have to do with options clusters, meaning like the machine C, like where everybody's betting, and they basically try to take them out, and then they run it against them. And these 40-cent calls can land up at 3. In the meantime, you're scratching your head, said, what the heck? Well, that's the reason why we rely heavily on the charts, and again we try to project whether or not we should dollar cost average. Very important concept. In other words, you bought one call at 2, let's say $200, and you buy another 3 calls at 40 cents. That's $120. So right now you have 200 and 120. So that's $320. But instead of one call, now you have 4. What is your average cost right now? Your average cost is 80 cents. Are you guys with me?
Yeah.
Yes.
Right. And this has happened many times. This is speculative trading. That's what I love about options. You don't want to go crazy, but depending on the charge, depending on all the different variables that are on the external market, this thing shoots up to $3. I've seen this happen with Apple a lot. And sometimes I want to slap myself because I didn't hold it, because I'm thinking, okay, what if it doesn't? And then I get out, but I always try to leave a little bit in there. Let's say I have 10 contracts at $2 grand. So I'll leave maybe 1 or 2 in there and maybe buy a little bit more at the 40-cent level. And then it goes to $3. So all of a sudden, your return is 700% plus. And you're going to see this a lot. Just so you know that, okay? So that covers the time value part. And now, different stocks have different options characteristics, just the way every human being has a different behavioral model. And some stocks options are going to be, you will have. Let's talk about this part, which is very, very important, and we deal with this every day. Is options prices. You go in to buy an option, and I'm sure you guys have encountered that. And it's a stock like, for example, let's look at the one that that we made money on, which is fantastic, SDGR, the biotech company, right? So I said buy the calls, the March 20. I believe I said buy the 50 strike price. There's not that many options on that. Let me see here on my other screen. Yeah, so I said buy the 50 and the 55 calls. The stock is at 47 at the close on Friday. Now this is a stock that moves $3, $4, $5, $6 a lot. You guys know SDGR. This is the one on the IPO. I told people to buy it at 27, around that level, and the thing went to almost as high as 56, 57. More than a double. At that time, you could only buy shares because there were no options. I just realized on Friday that they introduced options. Great. So now I can participate in the stock without having to put down a lot of money. So I went in to buy this initially. Let's say the 50. Which ones do I have? I have the 50 and 55 calls, small amounts. I went in to buy it, and it showed me let's talk about the 55 calls. 50 strike. Are you guys with me so far?
Yes.
Yeah.
Okay, good. Because this is the reality of what we deal with. There's the basics of it and all kinds of great academic, like, okay, if this happens, this will happen. But the reality is when you're on the battlefield, plan, you have to adapt as quickly as possible. By the way, this screen behind you is basically, these are those option Greeks, this math stuff, delta, vega, theta. Theta is the time value decay. The gamma is, the delta means how much the option will move based on a stock price. So the delta measures the correlation. If a stock moves $10, what is the possibility? It's a gambling game, right? What is the probability of how much you're going to make? And then there's gamma, and these are the two most important things, delta and theta. Okay, and you guys can read that up on your own time. It's kind of fun to know all that part. There are serious options players who make, who analyze the numbers, okay, the implied volatility means how much it's going to move over a period of 5 days, 6 days, and I don't get into that because that's a little bit too much. Because the reality is, if the market's in the excuse my French, in the shithole, I don't care about the delta and the vega and the theta. The option's going to be down. Okay, so I focus on the outside market to make a determination whether I'm going to bet long or whether I'm going to bet short. So anyway, let's go back to SDGR. So I went in to buy it, and as you know, for just like any other stock or option, there is a bid and an ask. And I don't remember exactly, but it was a very wide bid and an ask. I think one was around 4 or like 3, and the ask was 5. Like a $2 spread. It's known as a spread, right? Like a $2 spread. That's huge. And this we see quite often on the biotech stocks that we go in to buy. And it's very frustrating, and there's nothing we can do about it. So one of the simplest reasons is that there is less liquidity. In other words, the average trader is they're trading the Apple and Facebooks like wild. And the Apple and Facebooks, the spread is very small, which is great. But with these, they're saying there's not that many participants playing in those options, so they have to basically figure out the bid and ask. My reasoning is these machines, and they're known as options makers, market makers, they're just a bunch of bastards. They're just trying to steal your money. Okay, so they are basically keeping the spread, and I try to go in the middle and say, okay, let me try to buy it at 4. They'll at that point they'll move the bid to 4, and the machines do it very fast, and I'm sure this has happened to you guys, and they will move the ask to 550. So what do I do instead of chasing it? I don't want to buy it at 5 unless it's a stock that's like really moving. I'll jump in and buy right at the high bid at on the ask price, whatever they're asking. Okay, I'm not going to bargain in the middle. So, but generally speaking, I play around. I'll put in one call to test the waters, and I will put in at they're asking 3 to 5. I'll put in at 4 initially, and maybe I'll move it up to $4.20 and see whether they bite. I've been doing this for a while, so I'm pretty good at it, and let's see if they bite. If they don't, if they bite, the first thing they're going to do is, if you bought it, let's say they give it to you at 450. The first thing they're going to do, they're going to drop the bid. I see it all the time. Don't worry about it too much. They'll drop the bid. You bought it at 450. They'll drop it down to sometimes 350, sometimes 4, and they will, the ask, which they were asking at $5.50, they'll drop it down to 5. You're like, what the heck? You just lost 50 cents on something you just bought a minute ago. But it doesn't matter, because that's just standard procedure. On liquid options like the Apples and the Facebooks and stuff, this type of stuff doesn't happen. So I want you guys to understand this. Now, the reason, one is the liquidity part. The second thing is that it's not very heavily traded stocks. Like SDGR is something that works over a bunch of days. Sometimes it starts to run. Sometimes it starts to run in a big way on a certain day. You guys have seen that, yes?
Yeah.
Yeah.
Exactly. The good thing is that you guys have come into this market at a time when you saw very sharply rising markets, everybody's scared. And we'll talk about that on one session. I devote completely in understanding the dynamics of the market. No technicals, nothing, but the mental part. The mental part. Because on a sharply rising market, which I've talked about in my webinars quite often, and I felt it myself, and I've mentioned it in my webinars, I feel uncomfortable chasing things. And the next day it opens up, boom, it goes up another 20 points like a Tesla. Look at Tesla, what it did. And so it is equally difficult, believe it or not, to buy a sharply moving bull market. In fact, more difficult, because you're jumping onto a running train and it's moving. And I start to not completely stay out, that, but I reduce my position sizes. It is equally difficult to do this, to jump onto a moving train, or to jump onto a downhill slope like we saw in the past week. Okay, so the bear market, because here is like you buy it here, like, wow, it slips again. But to me, this is more favorable to scale in and buy. Why do you think that is?
Because prices are low now.
Exactly, exactly. And what you just said is one of the most important points about trading and investing is in a technical market like this, which is completely driven by, these high frequency trading machines, HFT. One of the biggest server farms, it's like these flat buildings, nothing but supercomputers running data from the Chicago Board of Options Exchange, the Philadelphia Board of Options Exchange. Those are the two major options exchanges, right? Running these big fiber cables. Guess where it is? It's in Mahwah. Mahwah, New Jersey, a little north of you guys, right? And it's just like these flat buildings. They're totally connected. Like within 1/10,000th of a second, data is going from they have this huge pipe. It was built like 20 years ago that goes under subterranean all the way to Chicago. And data is moving so fast through that because these high frequency trading firms, which are paying to use these computers, and that's the reason why the markets move like this, are picking up and moving at lightning speed. We can't do that. I'm fast, but machines are trading hundreds of thousands of shares within not even 1 second, 1,000th of a second, nanosecond. Okay, just so you guys understand that. So, so saying all that, let's come back to this. So when it's a widespread, guys, so basically, in answer to what you just said is the truth. Is from a technical standpoint, we try to determine, and I feel more comfortable buying buying on the lower end, slipping a little bit more, buying a little bit cheaper, and then and you get that reversal like we got on Friday, and it just is a humongous return on the money. I know a whole bunch of traders, even with smaller capital, who did very well, and because they were buying cheaper. So yes, it's easier to buy the cheaper prices than chase the higher ones. However, technically speaking, a sharply rising bull market, which we have encountered till last week, is actually psychologically more comfortable, right?
Yes, it was.
Exactly. So now it's psychologically uncomfortable, but the prices are like dirt cheap. So anyway, that's another day story. So anyway, so rule number 2: if the bid and ask is wide, you got to play around in the middle. There's nothing around it, and you got to sit there. Don't go in and jump and buy right at the thing because you're hot on that stock. That's the stupidest thing to do. Rule number 3 on options. What is the word scale in means? I keep on writing that in many cases.
Buy more.
Nope. I use certain terms. Add, which is to buy, right? I use entry 1, entry 1, entry 2, all the way entry 3, 4 sometimes. And I use the word scale in. Can anyone step up and just simple terms? And all the, we always explain things, very simply is, or at least thinking that those terms, because don't make this complicated. There's a lot of complicated stuff in this business. But so this one, oh, I've been talking and you guys didn't tell me that you can't see my board. Oh, my fault. I apologize. Okay, because I was writing all this stuff and that was covered. So scaling in. What do you think it means, guys?
Getting in gradually.
Yes, gradually. So if you're going to, let's say there is an option at $1 on the SPY. No, let's stick to this $2. Let's stick it on the head. And we want to buy the SPY calls for $2. You only want to put $1,000 in that trade because things are really cheap and you want to buy it. Remember, we were buying it at 60 cents, 70 cents. Those things went to like $2 plus by the time the day ended. The SPY calls that I was telling people to buy, they were down to like 40, 50 cents. It went to more than $2 right after 4. Remember, SPY calls and puts, you can sell till, I believe, 4:30 p.m. So they were shooting up after I took out a bunch of them. I left some, but I took out a bunch of them at $2 plus after hours. So these are the SPY calls You want to buy, your goal is to buy 5 contracts at the $2 range. So scaling in is very simple. It's a very simple method. I use that all the time. Depending on market conditions, I will step in with 2. Then market conditions move down a little bit, volatile markets. So you buy it at 2, and the next thing you know, it is down to $1.50. So the natural reaction of a trader who doesn't quite understand is like, holy shit, this is stupid. I just lost, 25% of my value. No worries. Looking at the charts, volatility in the market, you want to scale in. So you want to buy, you bought 1 at 2, you buy your second lot that's scaling in at $1.50. You don't want to rush in, depending, and this is why charts are so important. Now, if the market is bottoming and we're down 900 points and those calls are running around $1.50, you don't want to, you want to step in and buy maybe 4 calls, right? You want a dollar cost average hard, because at that point, if the markets are down 1,000 points, you've lost 50% of your value, and this happens all the time, especially last week. And by the way, what you saw last week is not something that is normal. It's beyond normal. So don't expect that type of 1,000 point moves and 600 point rallies intraday within 15 minutes too often. This is known as a vol moment, vol standing for volatility, and it's primarily run by credit guys and volatility guys. One of my neighbors, real smart guy, they wait for those vol moments, because the guys they always think the market's going to zero. And these are normally the credit bond guys, okay? Remember, the credit bond guys hate the stock market, and they're normally smarter, but they're really crappy at the stock market, so they never really make real money. But they basically wait for these moments, what they call vol moments. So just want to repeat to you guys is this is not something that goes on forever. Might lengthen a little bit, but the 1,000 point type of drops and stuff, it's not a common occurrence. Okay, it's known as a black swan event. Black swan means an event that you cannot quantify. Anyway, and we know the reasons all behind that. So you scale in. So everyone understand what scaling in means? Means not to buy everything at one go. Buy a little bit cheaper, or if it's starting to run, add one more. That's equally productive too, because this thing, if the market just sharply goes higher on a major piece of news, real news, and you want to basically buy higher or sell your one and move to a higher strike, which is the next new. So, the other word that I use is rollover. So add is simply means buy. Entry 1 means that this is my first entry, and depending on whether up or down, and I'd like to buy it cheaper if I think it's going to bounce back, that obviously benefits me because, for simple reasons, cheaper cost and more number of contracts. This simply means that that's the second entry into that particular series of calls. A rollover means that you bought the SPY calls at 2. Let's say the SPY is at 300. Okay, and it runs to and this happens a lot. You guys know that. And the SPY runs to 302, 304. Why sit on the same $2 call, which is at this point maybe $4? This is a very simple concept that most traders don't really, it's very simple, but don't follow. So they sit on the $2 one, they're up 100% on their money. And my general rule of the thumb is, if I'm up 100% or close to it on any call, I will take down full or partial profits. Rule of the thumb. Or in some cases, 50%. It all depends on the amount of money that I have in there. Option up 10, 20%, I don't really bother. Option up 50 to 100% range, definitely take full or partial profits depending on the size, how many calls you have. If you have one call, you can't sell it. You can't sell half a call, so you got to sell the whole thing. Are you guys with me?
Mm-hmm.
Aldi?
Yes.
Who's Jared?
It's me.
Hey, yeah. What's your first name?
Jared.
What's your last name?
Vincent.
Oh, yeah. How you doing? You're a
I'm
member, right?
pretty. Yeah. I was sick last week. I had the flu, so I couldn't really get on much.
Oh, okay. I hope you're feeling better.
Yeah, a lot better.
Good, man. They tested you out and everything?
Yeah. So I'm doing like a lot, 100% better.
Oh, that's awesome. They didn't put you into a quarantine camp. That's good. I'm one of my wife's friends. She's pregnant too.
Hmm.
The
Oh,
poor lady,
really?
like she caught the flu like serious, and my wife's like
Oh.
worried shit because she went to the doctor. Doctor checked it out. It's just a regular
Hmm.
flu. But anytime anyone's getting a flu nowadays, which can happen to anybody, it's like a warning thing, right? It's
Yeah,
like
because they weren't checking for coronavirus.
I know, exactly.
It's crazy.
And
And
it is crazy. Well, I hope you're feeling better, man.
thank you.
So that's why, absolutely, sir. So anyway, let's stick to this. So what happens is, what's a rollover? Aldi, let me ask you that question. Very important.
A rollover, this is what I'm
Yes.
thinking, is when we buy a call at $2 and it's
Yep.
moving up. So
Mm-hmm.
then you go ahead and buy the cheaper call.
Yep. Exactly. You sell it because it's at 302. The SPY right now is 304. I do this all the time. Like I can do it in my sleep. So now I sell the $4 call, and let's say I had four. I mean, let's say five to make it. So I put in $1,000, right, in this. Now I'm up to $2,000. This happens a lot. Okay, and so I will sell that 2,000, and then I will roll over and buy the higher strike. Now, if the SPY is at 304, I'm going to buy the 305 and 306. You got it?
Frank.
Or higher, depending on the market, whether the market's like technically like breaking out in a big way. I'll buy the 310s. Don't forget, these calls that worked out and still working out fantastic, they were way out of the money. They were 6-7 points out of the money. Then they went lower on Friday, because I originally paid 2 and I kept on buying them at 60 cents, 70 cents, and bang, they were up 300% from there. So,
Frank.
yes, go ahead.
Frank, one important part of this
Oh,
rollover.
let me finish. Let me finish this thought,
Okay.
so because it's incomplete, yeah, and then you can ask the question. So then what I'll do is I will take my 2,000 and I will use the initial capital, and it's called playing with the house money, right? Because you put in 1,000, you made 2,000, you put 1,000 aside, play with the house money because you made $1,000 in profit, and you buy the higher strikes. This way, the higher strikes won't be $4. They'll probably be $2. So you're spending less money. And again, you buy the $2 one, you use the same method, the scale-in method. You buy your first 2 at 2, and then you add up because you want to own 5 of them again at a cheaper price. So you're banking your 1,000, which the markets can't touch, and you're playing with the house money at a cheaper price. The higher the strikes go, as the market's moving, what we call a reflex rally, then you're paying cheaper for it, keeping most of your money on the side. Am I clear on this?
Yes.
This method works
Yep.
fantastic. Yeah. So what's your question, Franco?
So the question is, rollover. When you do the rollover, do you
Mm-hmm.
move into a higher, bet that is gonna go up? But
Yeah.
do you also move it to the next week, or you stay on the same date?
No. If I have time value left, let's say a week, I'd like to buy normally. Well, depending on like I'm talking the normal stuff.
Yeah.
Normal stuff is normally I'd like to have at least 5 trading days, especially with the spike calls. Okay, so I buy the next week's one. Now, if the markets, I want to play lottos, like cheap lottos at like 15 cents, which go to like 60 cents, then depending on market conditions, then I'll buy the same week's one with maybe 1 or 2 days left. But those you just want to do it with a smaller amount of money. You don't want to do it yeah, exactly. You don't want to put $1,000 in a lotto. Yeah, you can. It'll be like $5,000 within like minutes. If on Friday was a great example, but that's not something you want to use as general practice. Got it?
Hmm.
You might want to put $100 in. $100 put in at the lows on Friday would have been almost $700, $800. but those
Yeah.
are just the markets that we're dealing with. You know, Apple calls with 2 cents. 2 cents. I bought a whole bunch of them at 4 cents, 7 cents, 8 cents. Boom! It went to 47 cents, 500% higher, 400% higher. I got most of them out at around 30 cents. It's like, great. I could have done that on a series of things, but I'm human, man. I can't control lottos in a fast-moving market. I mean, how many hands do I have, you know? So what you can do, and we'll talk about this in a second, how to set stops and how to sell orders. So am I clear on this one? So we talked about entry 1, entry 2, rollover, very important stuff. And any other terms that I use. Scale in, very important. Explain to you all this. So let's move on with what was the topic I just thought of that I wanted to cover. Now, let me open up for any quick questions before as we're covering some very important stuff.
Hey, Frank, it's Al.
Go ahead, sir. Yes, Al.
Hey, Frank, real quick, the lotto. What do you? I'm a little vague on the lotto when you say buy some lottos because
Yeah. So I think I know your answer. Yes. So what is a lotto, right?
Right.
And what is a lotto? Well, the actual meaning of a lotto is like, okay, you buy a lottery ticket, hey, you're winning, so you lost $2 on the Powerball. But lottos generally have two different ways I put it. Lottos are options, and these are actual options, which are less than $2. So in other words, in the $1 to $2 range. Okay, I consider them lottos. The other lottos are more like extreme lottos, which are less than 50 cents or less. So they can be 10 cents. And you know, this has happened. All these Clovis and stuff, I keep on buying these cheap calls, 10, 15 cents. And boom, a week later, and I give enough time. Week later, the stock goes up $2, which is nothing for a $9 stock to go to $2. Yeah, percentage wise, it's beautiful, but no one gets excited when a $9 stock goes to 11. But these calls go to like $1. Like 80 cents. I've shown you guys 600, 700, 800%, and I got a ton of them just sitting there. One of my biggest days in my trading career was this a company we used to trade called Juno Therapeutics. They were supposed to get bought out. I had no idea when. We never know when they're going to get bought out. A bunch of my companies have gotten bought out. Buyouts are the most sweetest things ever. It's when you start really believing in God, okay, that God actually likes you. Just kidding. But the Juno calls, they were Friday calls. I had the Friday expiration, and then I had ones for next week. The calls I had originally bought at 3. The ones which were expiring that Friday, they were down to 30 cents. The ones for next Friday, they were around $2. They were cheap. And I had a whole bunch of these 30-cent ones. Oh, now I remember what very important aspect. So when they went from $3 to 30 cents, I taken some out, but I kept on buying more. So by the way, all said and done, I won't tell you how many contracts I had. So let's say that I had more than 30 contracts. I was forced to basically, cost average down. So I'm sitting there thinking, oh, here we go. This is going to be a nice, I'm going to lose 30 contracts. My average cost was somewhere around 60 cents. So I'm thinking to myself, all right, worst case scenario, I'm going to dump it at 60 cents or 50 cents. Take my lump, because my original cost was 3. The day before they expire, the stock gets bought out. Do you know where the 60 cents call went to?
$10.
And I won't tell you how many contracts I had. This is just a fictitious number. $10 my ass. I sold it at 40. Okay, I still have the print. I don't want to show it to people. I still have the print. Yeah, that's like because the company got bought out. So the company got bought out at a 45% premium. So the stock shot up 45%. And the calls, which I had given up for dead, well, I like the company. I knew at one point or another they work with Celgene, serious company, cancer therapeutics, what we call CAR T. So think about it. If you had one call at 10 calls at 60 cents, which is $600, you'd make 40,000. And that happened to a bunch of my people. So this is why we call options trading a and again, you can't time these things, but you understand, if you had the if you had 100 calls, yeah, you make $40,000. Now, in these type of crazy markets, sometimes these kind of things happen. Sometimes this kind of thing happens. So let's move on to one more aspect. One of the things that I find is that if I am accumulating a position, let's talk about this for a second. Options 5. What does accumulating a position mean? In other words, you're building a position. You believe in a company, you know it's going to work out over time. You don't know, it's not a fast moving stock. So you are basically, it's called accumulation. You're accumulating a position. You're building the foundation. Okay? Accumulation. Or you're building a position. This is different than trading the Netflix and renting it for like 2-3 days. All right? So this is the one that you're kind of married to. So you want to give yourself time, 1 month. So this is stock SYZ. Like I'll give you Clovis, these type of companies. I always accumulate positions because I can't trade them intraday unless they move up. Are you guys with me?
Yeah.
Exactly. So
Yes.
so 1 month, 3 months. Why not? Let me buy some time. So as you accumulate a position, you keep on, you start off with 1 call. Let's say you want to own 10 calls and the average price is 5, but you want to build this over time, depending on what the stock is and how it's moving. So this is totally different than trading what we call high beta, which means high momentum, the fast movers, right? One of the best stocks when it comes to cheap calls and they move is AMD. Okay, is AMD. AMD, you can buy, we were buying the calls, I don't remember exactly, like 40 cents, 50 cents, 70 cents, boom. They were almost $2 by the end of the day, or at least in the high ones. You just doubled your money. So these are high beta momentum stocks, and those are the ones you are not necessarily accumulating position, you're just trading with whatever you have in hand. You can accumulate a position in these type of companies, but you also have to be quick in selling them. These ones are a different story. These generally tend to be biotechs or specialized situations, which we're going to talk about the different characteristics of the different types of stock that we trade on a future session. Sometimes you are forced to dollar cost average because the market has forced you to do that, and that might be hugely beneficial to you, which is the fact that you originally wanted to own 5, but because the price went down, now you're forced to buy cheaper, and by the time you have it, you own 10 calls, and then the stock works, so you make a lot more money than if you had just 5 calls. So and I've seen that happen. Question.
Frank, so
Mm-hmm.
to accumulate a position in a particular stock 3 months out,
Mm-hmm.
do you buy the contract date 3 months out, or you
Yeah.
gradually? Yeah.
No.
That was my question.
Yeah. No. You always have to buy the contract date 3 months out. So, for
Okay.
example, the 3 months out would be what? March, April, May, right?
Right.
Should you look at the strike price?
You look at the strike price. So let's talk about options long term. And I have a mixture of things. One of my accounts, I just have long term calls, which I don't tamper around with. Stock companies that I believe in, and I believe. So I have a basket. I have a basket of them, few calls of each, and I don't have enough time to just sit there. So it's like having a portfolio of stocks, except I have a portfolio of options long term. So what you do is, like I said, you 1 month to 3 months, or you can go further out, but then it becomes more expensive. Remember, the longer your time frame, that means the more time that you're buying, you got to pay for it. So if it's 1 month and if it's 3 months, if this is $2, the 3 months ones will probably be $4. If you want to go out 6 months, then they'll probably be $6. Do you understand what I'm saying? So you got to pay up for the time, because we have time value and we have intrinsic value. So let's say the stock is trading at 20 and we expect it to go to 40. Like this company, SDGR, that I'm really, I did a whole bunch of homework on this, like serious stuff. And I also put out a report from Citron, which compared it with Tesla. Remember that? And
Yeah.
Citron guys are a bunch of really, really smart guys. I don't like them too much because they like shorting things, but they make a lot of money. When they come out and say they're shorting a stock, the stock falls immediately 10%. Immediately. They have a big reputation. They're like the wolves, serious, but they're smart. Like when they do research, his name is Andrew Left, Canadian guy. And he's not kidding around. They do serious research, like investigative work. And then they say, oh, this company's making up numbers. Boom. So when they come out and they actually like a stock on the upside, and these guys are short sellers, something has to be said. And remember the stock, I didn't know the report was coming out, but when we first bought an IPO, the stock went up to 34, 35 within 2 days. Pulled back, we bought it again, and then Andrew left Citron, Citron, yeah, Citron, like the drink. And boom, the stock goes up another $5. So yeah, so I buy the 40s. I think it's going to go to 40. I buy the time, 1 month, 3 months, 6 months. I buy normally 1 and 3 months. Why do I not buy the 6 months? Because I have no freaking idea what it's going to do in 6 months. And 3 months is good because it takes into account one of the earnings quarters. Got it? Because companies report every 3 months, right?
Yeah.
Every quarter, every 4 months, January, February, March. Yeah, March quarter, every 3 months. So I always get confused. So bottom line is you want to buy 3 months out because it takes into account one earnings cycle. So it's good. And so did that answer your question, Ray?
Yes, it did. Thank you.
Yeah, exactly.
Frank,
So yeah, go ahead.
Frank, this is Al. Just a quick thing
Yeah.
on the lotto.
Yeah.
So on the lotto, when you're buying the lotto, you're looking more at the price than the strike price, correct? Or
With the lottos, I am looking at both the strike price and the price of the stock, both.
okay.
So for example, an extreme lotto is GE, right?
Okay.
So an extreme lotto is GE. GE calls it dirt cheap because GE is cheap compared to where it was. So those lottos you can buy at 10 cents, 20 cents. A whole bunch of them that I have are right now almost down 80%. But these are the 16 calls. These are like March 16. So if the market really rallies, those are like 1 cent. They'll go to 4 cents. Do you know how much money I can make? And so those are exactly, and I've done it with GE, so I don't kid around. The ones on Friday, which are the 12 calls, these are March a strike price 16, not the day. Which were the 11 or 12, those things were up 120%, and GE was only up a few cents, but up nicely from the bottom. So this is a case of extreme lottos where you can buy it as cheap as 5 cents, and I am looking at the movement on the price. And I'm looking at the charts. I do a combination of both. I just can't just look at the price and buy it. I got to look at it. I still believe that going forward, as things stabilize, GE can move up $1 or so. The stock is right now at $11, 1091 to 1095. GE is around $11. If the stock moves to 12, these things will be up 500%. These will be up the March 12 calls. If it moves up just $1, we'll be up at least 600%. GE calls are the cheapest and the most extreme form of lottos. Another one that I used to play in a big way, cheap lottos, which paid the bills nicely, and I'll start looking at it again, but I haven't been playing banks lately, is Bank of America. Bank of America lottos are all in the range of 20 cents to 30 cents, if not cheaper. And when Bank of America even goes up, let's say 50 cents, these lottos generally tend to give you anywhere from 100 to 200%. Now, the lottos, which are the extreme ones, which are expiring the same day, those obviously you put in a little bit. If it works, it works. If it doesn't, see you later. On a day like Friday, a significant amount of lottos that I didn't push, okay? I did a couple of them quickly myself because things were moving so fast, as you know, so I didn't want to put it out there. They literally, in the last 20 minutes, went up by 300%, including many of those calls that I asked people to buy on multiple positions, including AMD and stuff, and Spice, and IWM. So, so that's how lottos work. But generally speaking, two types of lottos. I just want to repeat. The really cheap ones that you're best wanted to hit the jackpot, and then the regular ones, which are less than $2, where you can buy a little bit and not get blown out because they are worth $4, $5, $6, $7, which are the story with expensive stocks. Now, final thing that I'm going to cover before I take a question or two is options prices. How does it work? Generally speaking, stocks that are $10, options will be $1 or less. Okay, anywhere from 20 cents to $1. Stocks which are $20 will generally options will cost maybe $1 to $1.50. Just giving you a rough idea. Let's say a stock is $50. Options will be in the $2 range, 2 plus. Options which are $100. I mean stocks, which many stocks that we trade, those options, if you and I'm talking buying in the money, roughly, or close to the money, what we call NTM, near the money. So with the case with the $10 things, I buy directly in the money. Are you guys with me?
Yes.
Yeah.
Very, very simple but effective tools. I buy directly in the money because they're so cheap. Why bother buying out of the money? With these ones, I also buy in the money. With these ones, I buy slightly out of the money, what we call OTM. So in other words, if the strike price is 20, I'll buy the 21s. I'm not going to buy the 25. Sometimes I do, but depending on the option price, they're just slightly out of the money. If the stock is $100 or the $150 stock or $400 stocks, we trade a lot of them, as you know. On those ones, price-wise, I will buy. On the $100 ones, I will buy strike prices of 105, 110. On the 150 ones, I will buy strike prices of 160 to sometimes 170. When which are the $400 stocks, I can buy, and depends. I can buy as high as 440. I can buy sometimes as high as 480, depending on the stock and depending on how much time I have. So as the prices of the stocks go up, if it's $1,000 stock, like a Tesla, you look at the options table, it's like crazy, the premiums, right? Just to buy one call, it's like $25. Like one call would cost you $2,500. It's a, it doesn't make sense. A lot of traders do. They, okay, fine, I'll trade with $2,500 just on one call. But $1,000 calls, I will buy $200 to $300 out of the money, depending on the stock, and the option will still be quite expensive. Got it? And
Yes.
let me see. Okay, so quick question. I got 10 more minutes. We'll wrap it up. It's a great first session with you guys. What else? Let's take a look at, while you're thinking of a question, go ahead.
So can you give me an example on a specific call with these option prices? Because I was a little confused before when you mentioned that the bid and the ask, and you were like, well, I'll only bid, I'll bid under the asking price. Because up until now, I've been purchasing the market. So
Oh,
Whatever the
okay.
market.
Well, after this session, you're never going to purchase market. Oh, you can purchase market on the fast-moving Facebooks and Apple and stuff, but with a wide spread, you never want to purchase the market. So I'll give you a real-life example, okay? And we're going to talk about one with a wide bid and spread, which is SDGR, okay? So
Okay.
let me get that screen in, or maybe I can change the screen. I can change the screen. Hold on. I hope you guys are finding this first session helpful.
Very.
Yes, very, very
Yes.
helpful.
Okay, that's awesome. I'm trying to figure out how to change this freaking screen. Hold on. Yeah, and it gets deeper, man. As we move along, as you guys, use some of these techniques on the front end, and we do the next session, it's going to get more and more advanced, and then we're getting into some real detailed technical stuff. So you look at more, and next session, actually, we're going to jump a little bit, and I'm going to pick one or two of my charts and explain every single part of it. Every single part of it is a big story behind it. So that part I'll explain briefly. Then you guys are going to check, you guys are going to learn on your own, because the thing is, you guys are not just training, you're actually fighting right there on the ground. So it's actually more advantageous. You know what I'm saying? It's not just, oh, I'll train and then I'll go trade. And all of a sudden it's like, what? The markets, it's like a battlefield. You train and then you get out in the desert and they're like shooting from you from all sides, like the market. So you're doing it both. So that's great. So where is this screen stuff here? One second, my friend. Okay, I'll just pull it in. I was trying to change the screen. Still have to get used to the format here. Okay, that's not the one.
Frank, question. When you
yeah, go
use the
ahead.
term ER, that means what?
ER is simple. Earnings trades, earnings reporting, ER trades, which is a completely different ballgame. We play them all the time. We get big runs on it. Some of them don't work. Most of them work. And one of the big ones, when they work, the calls go from, I show it. I'll buy one or two calls at $5, $6, $7. And these are expensive stocks, right? But I'll show you a trick. I look at, well, I can't show it on this screen. I look to see what the IV is right before I like, let's say stock is $400, right? And I'm trying to think of an example. We had a couple of huge runs. So anyway, so I look at the IV, which is printed on the top. Here, printed on the top here. See that MMM? And so that means the stock has a possibility of moving 10, 15, $20. So I said, fine, I'll buy one, I'll buy two, because I like to buy the basket. $5, $6, boom, opens up. I'm selling it at 18, 19, 20. It's happened a lot. Go through my Twitter feed, Mr. What do you call? I know Franco has seen a bunch of them, and I think you caught one or two of them, right?
Where do you see the MMM again?
Where do I see what? The implied volatility right there.
Yeah. Oh.
Right there. Okay.
Yeah, I see.
So one second. That's one of my doggies. So let me just show you something on the bid and ask. So here is where you see the implied volatility. Not on every stock, but generally right before earnings, the system, Thinkorswim, and their systems are very, very complicated and advanced. They will give me an idea of what the movement on the stock will be. And you'll see that on the news under the stock too, implied options volatility. In other words, plus minus, how much can they move? Got it? Are you guys with me on that one? So the higher this number is, gets me a little bit more excited. The problem is the options are equally very expensive. Because if a stock is going to move 40, 50, $60, like an Amazon, the implied volatility is generally 150. So in other words, because of the stock price, the stock can move 150 points up and down, and it's certainly moved a lot more on earnings, right? So the point is that the options will be accordingly priced, and you have to make a bet whether or not you want to buy the cheap options or whether you want to spend some money and buy it in the money options, which means it'll cost a lot. So let's say you put $1,500 buying one contract because the contract was $15. You bought one call close to the money and the stock goes up 150 points. You will sell this somewhere around 40. So your $1,500 will be worth 4,000. Okay, and this happens on earnings a lot. If it blows up, then your $1,500 won't go to zero, but it might be down to like maybe 300. If the stock is having a reversal, we're going to talk about it the other day. I talk about reversal trades a lot. Some of them have worked out fantastic. A lot of the times the machine will drive the stock down after hours or right when it opens, and then boom, pick it up and start running it. Next thing you know, the stock's like, whoa, right? And reversal trades can be very exciting. So they were down to 300. You add another 300. Next thing you know, you are not just not losing money. You're like making Bitcoin. What I'd like to see is the stock pops up right in the morning, so I can sell it and then reevaluate if I want to get back in. So do I like reversal trades? Stock crashing right after earnings? No, I don't. Okay, who does? But depending on the reversal trade, I find another opportunity which can give me a bigger bang on my buck than just selling it on at the high, at the open. Those are ER trades. Am I clear on that?
Yes, thank you.
Okay,
Yeah.
now let's talk about this part. And I think it was Ray who asked the question regarding bid and ask.
Yes.
Okay, so look at the bid and ask here. SDGR, one of my favorite stocks. Schrodinger, Bill Gates, big funding. Bill Gates and big shots are in there. It is in the biotech field. They have disruptive, like hardcore artificial intelligence codes and stuff, software to manage all types of different biotech clinical trials and everything, like serious stuff. I got to read up on it more this weekend. And no one talks about it. Great. So when I made no one on the media. So look at the bid and ask here. If the 55s, the stock's at 46. So if you went in to buy the 50, the bid and ask here is $1.80, $1.10, right? Right? Do you see that?
Yeah.
So
Okay.
Yes.
so that means these guys, one sec. These guys are marking it up 20%. You got to pay 20% VIG, like it's almost highway robbery, almost 19.3%. Let's call it 20%. So, you know, somebody really juiced up on this company, they don't have time to go back and forth. These guys will mark you up. The markup is 20%. See that? So who makes that 20%? Immediately the guy the options maker who sold this options to you, and we'll cover that in another session. Like, where do options come from? Somebody else holding a stock is basically selling options. You can sell options too, and collect the premium, you know. And so he immediately makes 20% because you bought it right at the market price. Got it?
Yes.
Exactly. So I play around the middle. Let's look at the 55 calls. These are March 20 calls. I'm probably go out in April too. So the 55 Aprils are 3 to 4. That's 33% markup, right? So you say, man, this is crazy. Well, that's business. Okay, you gotta. They know, like the new trader with no idea will pay up $4, saying, what the hell? It's just $1 higher. But the guy just made 33% of the money, or the firm that is, selling those options, the market makers. So that's why I'm saying the bid and ask, you got to play. Now the same thing is on the put side. $2 here, $4 here, almost. The bid and ask, right?
Yep.
And so April, let's see, April's are again almost 20% more bid. I mean the markup, the 60 calls. Oh my lord! Look at the 60 call bid and ask. 6.1 divided by 3.6. What? 1 second. Is that right?
No, they're wrong. I think it's 350. Yeah, it's like 90%.
No, not 90. It's is it 90%?
It is about 90.
Yeah, look at that. They left it at 90%. So these guys are total highway robbers. So somebody like liking Schrodinger just saying that they're like, dude, he just got paid for doing nothing, selling you a freaking call. Like, you're talking about highway robbery? This is just like random. So this is a very widespread. Now, why is he leaving it at 360? Because whoever bought the 19 calls, I don't know. I mean, you can look at the time in sales. They probably played around and got in the middle, but then some sucker must have bought it at 6. So the guy's like, dude, I want to get that guy every time, right? So to pay up for this stuff. So you got to play in the middle. This one I wouldn't pay with a spread of $3. I mean, $2.50. Rule of the thumb is you try to go in the middle. You try to go in the middle. So I'll initially what I do is I'll put in 420. Immediately they're going to put this up to 420. I'll tell you, like the machine do it automatically. 420, they'll keep the ask at 6, just in case I get greedy and bite that. I don't want to do that. So then I'll move it up to 450. So I move in increments of 30, 40 cents and with a very small amount. Because if the machines see you're coming in with a big number of contracts, they are never going to give you the price. You come in with 1 or 2, they'll be like, okay, fine. We'll meet somewhere in the middle. You come in with 10 contracts, they won't give you the price. You got it? Now this is not true of. That's what I mean by the minute. Okay. Now let's take a look at. I got to start wrapping up. Hold on. Let's take a look at. a Apple. Very liquid stock, and it's a whole different story. Okay. So let's look at the ones expiring next week. 275 calls are $9. Can you believe that? That means they're betting that that Apple will jump. Look at the implied volatility for next week, $14. $14. So let's say you buy $10 out of the money. So look at the bid and ask. Actually, I wanted to point out something here. I noticed one thing and I forgot to post it. I saw a lot of wide spreads on Friday that I haven't seen, even on stocks like this. Like Apple normally will never have a $1 spread. Never. Let's take a look at AMD, which would be a better example. I saw a lot of wide spread, even on cheap options, like 40 cents to 60 cents. That's a 50% markup. You know what I'm saying? I saw a lot of them because that it was, it's a different. Friday was like all machine driven. Well, every day is. And there was this big pension fund that came in and bought $30 billion worth of stock right in the last hour. That's why the markets went up. A big pension fund stepped in. They normally don't do it in one day. They normally spread it out. But they probably said, what the hell, we're going in. $30 billion. That's the reason why the market turned around. Okay, you got $30 billion worth of stocks to buy. What do you think the market's going to do? So in the case of AMD, even these spreads are wide. See, I told you. So let's say you want to buy the 48. We were buying the 49s. They were cheap and they moved. This is the $1.20 by $1.40. Normally, it would be $1.20 by $1.25. Normally speaking, you got it. It's never like this. So it's very strange. $1.10 to $1.50. That's a wide spread. Normally, it's $1.10 to $1.20. And you can, at that point, buy the ask or play in the middle and just 5-cent increment. If it's $1.10 by $1.20, I put it at $1.15. Got it?
Mm-hmm.
Okay. Now, the last thing that I'm going to show you guys is this, which is important when you're looking at it. It doesn't give you like a full indication, but it's a good indication, which is known as open interest versus volume. Here, somebody, so the stocks are 46, somebody's betting, this is the volume it traded. Now it's buying and selling, obviously, but the activity on the volume is this, large volume, obviously. This was the open interest. Open interest simply means what was the number of calls available there the day before. Got it? So when you see a large concentration of open interest, it generally signifies that more players are betting that the stock is going to be going up towards that level. like the 40, there's a lot of open interest, means that that's the position sitting there. So you buy 2 calls, it's going to get added on there. So there's 4,000 calls on one of the exchanges. There are more, but I don't think they show it all. But 4,000 calls. It gives you an indication of where the bets are being placed. Got it? And that's known as open interest. The volume means how many of them traded that day. Look at how many traded that day, 6,093. And the open interest the day before was 3768. That means there was a lot of buying activity on those calls on Friday for next week. Got it? Now, you guys are with me so far?
Yes, we are.
Yeah.
You hear, the Najarian brothers, they run those, they come on Fast Money, they have their big option service in Chicago or somewhere. They always talk about, like, they're seeing big open interest and volume, and they talk about options all the time. You know the guys I'm talking about, the guys with the twin brothers with the little goatee, right? You guys know who the Najarian brothers are?
No.
You guys never seen them? You've seen them 20 times. They're always on CNBC. These guys are big shots. They're the ones who just study the open interest, the volume, cluster of options, and they mention a whole bunch of them. So, yeah, always have CNBC on the side if it's available. It's very important to keep in touch with, what's going on there. All right, so we shall wrap up. Any last question that I answer quickly?
Hey, Frank, it's Al. I just got a quick question. I know that
Yes.
I'm just starting out on this.
Yeah.
I have a TD Ameritrade.
Yeah.
And apparently, how do I get around, or how is there a get around, or is there any way? Because I know that when you buy, you have
hold on. Get around what? In a cash account less than 25, so you can use the money again?
Well, what happens is turnaround trades.
And I know what you're talking about.
Yeah.
This is the way you need to do it. Okay, because I have multiple accounts. So one of the accounts is less than 25, right? So how to get around to it? If I remember correctly, you have to tell them that look, I do not want to be a pattern day trader, in which case they will restrict you if your money is less than 25, right? So, and you can do round trip trades the same day. In other words, use the money the same day, but you tell them to put your account in a cash. It's known as a cash account, not a margin account, cash account. Okay. So you tell them to put your account designated as cash account. So what happens with a cash account is that whatever you buy today and you sell tomorrow, the money is available for you to use immediately. It's called T+1. The settlement date is basically from the trade date that you did to where is my thing pad here? So I was going to show you. So this is the way it works. You can use that money. So here's a real life example. That's the way you get around to it. That what you sell, let's say. So first of all, you tell them to put your account designated as a cash account. Okay. I need a response because there's a question directed to you. Yeah. So you need to tell them to put it into a cash account. This is the way to get around it, and it's not legal or anything. They put it in a cash account. So there's a settlement date for stocks. For stocks, the settlement date is T+3. So the day you did the trade, let's say you did the trade on Monday, and you sold it, then whatever the thing you did, like you sold it on Monday, it will take 3 days for that dollar to settle. That's the settlement date, T+3. For options, it is T+1. Those are the rules of the exchanges. What is T+1? You bought an option on Monday, you sold it. No, I'm sorry, not a bought. If you buy it on Monday, you sell it on Tuesday. So you put $100 in here. That is up to $200. You can sell it. You can sell it on Tuesday, and then use the money right away. Got it? Now, if you have a cash account, because it works for one of our accounts very well. If you have a cash account and you sell it the same day, the money is not going to be available for you, but you can sell it the same day. But you can't use that money because it hasn't settled. It'll settle the next day.
I got it. Thank you.
Yeah, and push them. I mean, some of those guys don't know, and they're like, "No, you need to." No, you say, "Listen, it's trade date +1. T+1. So put it in a cash account. So this way you don't have any round trip violations. You're not designated as a day trading account. That's it. That's what you want. And ask one of them. They're very helpful, most of them. I don't want to be a day trading account. I just want to use my money. So some of them will say, oh, no, you have to wait 3 days for money. The garbage. Say that whatever you buy today and you sell it tomorrow, you can use that money right away. If you buy it today and sell it today, you don't get a restriction on a cash account. You just can't use the money till the next day. And this gives you a lot of flexibility, because one of the key things about options trading is the flexibility of movement, shifting position. That's another day session. That's a very important one. That I can teach you, but it'll only come from your own experience. How to shift positions, take a loss here, move there, use that better, things like that. That just comes from experience. That's nothing I can teach in one day. Okay, guys, it's been a pleasure. The only thing that I want from all of you, as you know, is referrals. We are a referral-based service. So you guys came in through referrals. So please get a couple more referrals, few other friends of yours and stuff who really want to take advantage of this type of and this is the first day, of this type of in-depth training, both on the options logistics, and I'm going to teach you about market, my technical charts. And trust me, after these 5 sessions, many of my members have continued with these group sessions because they want to enhance their knowledge, And I don't charge an arm and a leg for these things. It's an hour and a half, and the money is of great use. So definitely referrals, and the other people who have joined, tell them to sign up for the ACS. I will continue doing these sessions midweek after work, and then of course Saturday morning. All right, sometimes Sunday morning, but not most of the time. On that note, God bless you all. I will see you guys on Sunday evening. Fingers crossed. Let's see what happens. But whatever happened this week, and we survived, and the people who survived in the green, let me just say one word: nothing can kill you. Because if you survived this week and you came out green, okay, I did, and I know other people who did.
I did.
Yeah, you did. Jeanette did. And
Oscar
I'm sure
did.
some other people. And Oscar, of course he did. He's like losing his head. He's like, he's mine, man. He owes me. Just kidding. But so he owes me big. So the thing is that nothing else can destroy you, because this week was it. It will go in the history books. 100 years from now, people will read it. 50 years from now, people will read it. Believe
It
me when
was
I tell you.
nasty. It was nasty.
No, nasty doesn't describe it. Nasty doesn't describe it. Seriously, you don't have a word in English to describe it, like what happened this week. And so if anyone survived this week, even with minor losses and didn't completely blow up, they're going to make a ton of money, long and short, going forward. That's all I'm going to say. These sessions will help you manage your portfolio. Okay, and you guys will be beautiful. I'm telling you right now. Some people are faster, some people are slightly slower learner. It doesn't matter. On that note, God bless you all. Thank you.
Thank you.
Anytime.
Thank you.
Thank you.